Welcome to this audio summary of financial intelligence, a manager's guide to knowing what the numbers really mean by Karen Berman and Joe Knight. In today's fast-paced business environment, understanding financial statements and the stories behind the numbers is more important than ever. Yet, for many managers and employees, finance can seem complex and intimidating. This audio guide is designed to demystify business finance and empower you with practical skills for interpreting financial reports. Whether you're a seasoned manager or just start your business career, you'll discover how to read between the lines of income statements, balance sheets, and cash flow statements. You'll also learn how assumptions, estimates, and biases can shape financial results, and why developing financial intelligence is crucial for making informed decisions and influencing your company's bottom line. Throughout this summary, you'll gain insights into the art and science of finance, explore key financial ratios, and find out how to calculate and understand return on investment. You'll also see how effective working capital management and financial transparency can strengthen your organization. Let's begin your journey toward greater financial intelligence. Financial intelligence. While numbers are precise by nature, finance itself is both an art and a science, shaped by assumptions, estimates, and biases. Grasping the basic terminology, concepts, and principles of finance is essential, but it's equally critical to recognize that numbers can be manipulated to present a version of reality that may not reflect the true situation. Financial intelligence means being able to interpret financial statements beyond the surface, identifying the influence of assumptions, estimates, and biases to understand what the numbers genuinely signify. Although finance lacks rigid rules, professionals follow common standards and guidelines. Companies should apply these guidelines consistently so their financial data can be understood by others. The three most crucial financial documents are the income statement, the balance sheet, and the cash flow statement. These are interconnected, and transactions recorded in one are reflected in the others. Non-financial managers and employees can significantly impact their company's financial outcomes by developing financial intelligence and recognizing how their actions affect the bottom line. When all employees work to enhance their financial understanding, the entire organization benefits. Introduction. In financial intelligence, Karen Berman and Joe Knight clarify the three main financial reports: the income statement, the balance sheet, and the cash flow statement. They offer practical advice for managers and employees seeking to have a greater influence on their company's finances. The authors challenge the notion that the numbers don't lie, demonstrating that finance is as much about judgment as it is about calculation, subject to bias, assumptions, and estimations. Nonetheless, there are accepted rules, guidelines, and formulas that standardize business finance. By building financial intelligence, employees can become skilled at reading and analyzing financial statements and better contribute to their company's success. The art of finance and why it matters. Though finance may seem like an exact science, it is also an art. While numbers themselves are objective, many factors influence how financial reports are prepared and interpreted. It is vital to understand basic financial terms and concepts, but also to realize that numbers can be presented in ways that may not match reality. When reviewing financial statements, consider these four key questions. 1. What assumptions underlie the figures? 2. Are there any estimates involved? 3. What biases do these assumptions and estimates introduce? 4. What are the implications of the answers to the above questions? Financial intelligence. Knowing what the numbers truly mean leads to a more accurate evaluation of a company's financial condition and results. It enables leaders, managers, and employees to work more effectively and feel more connected to their roles. Though there are no absolute rules in finance, accounting follows a set of standards and guidelines. Otherwise, numbers would be meaningless. In the United States, these are known as generally accepted accounting principles. Companies often prepare both GAAP and non-GAAP financials to provide a fuller or alternative picture of their financial status. Reading the notes accompanying financial statements helps uncover the real story behind the numbers. The many peculiarities of the income statement. Profit is the ultimate aim of any business, and the income statement is where it is reported. Understanding the income statement is key to assessing a company's profitability. However, income statements can vary widely, influenced by bias, assumptions, estimates, and sometimes manipulation. The art of finance means profit is itself an estimate. The income statement shows, for a given period, the company's sales or revenue, the costs and expenses incurred during that time, and the resulting profit after all costs and expenses are subtracted. In essence, the income statement reflects a company's profitability. Accounting and finance do not represent reality directly. They reflect reality, and the accuracy of that reflection depends on the ability of accountants and finance professionals to make reasonable assumptions and estimates. While this may sound straightforward, several factors can complicate the understanding of an income statement. It is important to consider the context. Is the statement for a division, a region, or the entire company? Some income statements are actual, reflecting real results, while others are pro forma, projecting possible outcomes. All income statements share three main figures: sales or revenue, costs and expenses, and profit. Annual report income statements usually include comparative data for 3 years. Footnotes are crucial as they explain the reasoning behind the numbers. Ultimately, income statements reflect the choices accountants make about which transactions to include and when. These choices introduce estimates and assumptions. The timing of revenue recognition is a major factor in the complexity of income statements. Costs and expenses can also be manipulated. Depreciation and amortization accounting can significantly affect and sometimes misrepresent profitability. Profit comes in several forms: gross profit, operating profit, and net profit. Understanding these differences, how accounting practices affect them, and what they reveal about company performance is essential for assessing true profitability. The balance sheet reveals the most. While managers often focus first on the income statement, finance experts prioritize the balance sheet. While the income statement tracks revenue and expenses, the balance sheet shows the company's worth at a specific point in time. It lists what the company owns, what it owes, and the resulting equity after liabilities are subtracted from assets. Like the income statement, the balance sheet is subject to assumptions, estimates, and bias, as there are multiple ways to interpret and record line items. The assets section of a balance sheet typically includes cash or cash equivalents, which is liquid assets; accounts receivable, which is money owed by customers; inventory, which is unsold products; property and equipment, which is purchase price; accumulated depreciation; goodwill, which is intangible assets from acquisitions; intellectual property, patents, and other intangibles; accruals and prepaid assets. Liabilities include the current portion of long-term debt, short-term loans, accounts payable, accrued expenses, and other short-term liabilities; deferred revenue, long-term liabilities. Subtracting liabilities from assets gives owners equity, which also includes investor funding and retained profits. The balance sheet must balance. Any transaction on one side, which is the assets, will appear on the other side, which is liabilities or equity. Transactions on the balance sheet are also reflected in the income statement, and vice versa. Accountants and finance professionals strive to provide the most accurate picture of company performance, knowing they can never capture the exact reality. Cash is king. Among the three financial reports, the cash flow statement is often the least understood and the most overlooked. However, it is the least affected by the art of finance, making it vital for assessing a company's financial strength. To savvy investors, cash is king. Solid profit is positive, but it is not the same as having cash on hand. Cash is essential for covering operating expenses and investing in the company's future. A company's ability to turn profit into cash is a key indicator of financial health. Even profitable companies can face trouble if profit is not quickly converted to cash, which is common for businesses with large accounts receivable. Conversely, cash-based businesses may mistakenly equate high cash balances with high profits. The cash flow statement tracks cash inflows and outflows in three main categories. 1. Operating activities. cash from customers and payments for business operations. 2. Investing activities, cash used for business growth and investments. 3. Financing activities, borrowing and loan repayments. Understanding not only the cash flow position, but also the sources of cash is important for assessing financial health. For example, cash from operations is positive, while heavy reliance on financing or investment cash may indicate difficulty meeting expenses. Managers can influence cash flow through their management practices, encouraging faster accounts receivable turnover, timing capital expenditures carefully, and maintaining lean inventory can all improve cash flow. A common set of accounting rules allows for reliable comparison of financial results between companies, industries, and years. Ratios. Learning what the numbers are really telling you. Ratios are valuable because they provide a quick, clear way to interpret financial reports. They express the relationship between two numbers and are widely used in financial analysis. Ratios enhance financial intelligence because raw numbers alone do not tell the full story. Ratios offer a more comprehensive and dynamic view, enabling comparisons over time against projections and with industry averages. Comparing ratios is easier than comparing raw numbers. However, while ratios are expressed in absolute terms, they're often based on numbers subject to the art of finance. Typical categories of ratios include profitability, how well the company generates profit; leverage, the extent to which the company uses debt; liquidity, the company's ability to pay its bills; efficiency, how well the company manages assets and liabilities. Managerial decisions are often driven by investor perspectives, since public companies answer to investors. Investors focus on 5 key measures of financial strength. 1. Revenue growth year over year. 2. Earnings per share. 3. Earnings before interest, taxes, depreciation, and amortization EBITDA. 4. Free cash flow. 5. Return on total capital. Each industry has ratios that are particularly important. Managers should know which ratios matter most for their business, as there are many opportunities to influence these and improve the company's financial position. How to calculate return on investment. Business decisions about capital investments are guided by the principle of the time value of money. To assess whether an investment is worthwhile, its returns must be evaluated over time, not just its current cost. Several calculations help financial managers predict an investment's value and its potential return, collectively known as return on investment. The building blocks of ROI include future value, present value, and required rate of return. The more non-financial managers understand these calculations, the better they can contribute to profitability and make informed decisions about capital expenditures. Analyzing a capital expenditure requires determining the initial cash outlay, projecting future cash flows from the investment, evaluating these future cash flows to determine the return. Methods for evaluating capital investments include payback, the time needed to recover the initial investment; net present value, considers the time value of money, the required rate of return, and the present value of returns relative to the investment internal rate of return, the return generated by projected cash flows. When evaluation methods yield conflicting results, net present value is usually the best indicator for deciding whether to proceed with an investment. It is important to remember that estimating the value of a capital expenditure involves judgment. Changing variables changes outcomes. Unrealistic projections of returns can lead to poor decisions. Applied financial intelligence, working capital management. Effective balance sheet management can greatly improve a company's financial performance without changing sales or costs. Good balance sheet management helps a company generate more cash faster, reducing reliance on investors or lenders. Financial intelligence also enhances a manager's ability to influence working capital, which affects profitability and cash position. Working capital is the funding needed for day-to-day operations, calculated by subtracting current liabilities from current assets. Accounts receivable, accounts payable, and inventory all impact working capital. The more money tied up in working capital, the less cash is available for other uses. Managers can improve the balance sheet and working capital by reducing day sales outstanding, which means speeding up accounts receivable, optimizing inventory levels, managing accounts payable to balance working capital and cash conversion, creating a financially intelligent company. Increasing financial intelligence by understanding the concepts and formulas used by financial experts helps people become better leaders, managers, and employees, even without an accounting degree. Companies of all sizes benefit when employees understand these basic principles and how they apply to their business. This knowledge creates context, meaning, and shared objectives throughout the organization. Employees who understand their impact on financial performance are more engaged and productive. Every company should develop a financial literacy strategy embedded in its culture and continuously nurtured. Small companies can hold brief, regular meetings to share numbers and reinforce goals with visual reminders. Large companies should adopt a top-down approach that emphasizes the importance of financial understanding at all levels. A risk in large organizations is assuming all leaders and managers are financially literate, which is often not the case. Ultimately, financial transparency should be the goal. Honest information sharing builds trust and strengthens the organization. Conclusion. As we bring this audio summary to a close, remember that financial intelligence is not just for accountants. It's an essential skill for every manager and employee who wants to make a meaningful impact on their organization. By understanding the core financial statements and recognizing the influence of assumptions, estimates, and biases, you can make better decisions and contribute more effectively to your company's success. Financial intelligence enables you to see beyond the numbers, ask the right questions, and drive positive change. We encourage you to apply what you've learned here in your daily work, whether by improving your understanding of financial ratios, managing working capital more effectively, or fostering a culture of financial transparency within your team. When everyone in an organization develops financial intelligence, the entire company benefits. Thank you for listening, and we wish you success on your journey to becoming a financially intelligent leader.